Hey all my future buyers and sellers out there, I am here to teach you more than you knew before about the real estate process. And first time home buyers, have you ever been on the phone with your lender and you not only got lost in the numbers, but also in the words that they were throwing at you? Well, you're not alone. I mean, from time to time, I even get confuzzled with their jargon. So I am here and I put together a lender vocabulary list so you can follow along with them with ease. So without further ado, let's get into it. Hey, it's Ella with Ella Estate Realty and welcome back to my channel. Now, if you love real estate just as much as I do, smidge less, smidge more, definitely hit that subscribe button so you never miss an episode because I give you a weekly dose of all the tips, hints, and hacks you can handle about real estate. As for today's topic, we are going over and deep diving really all the definitions, terms, things that you're probably going to encounter as you're applying for a loan, talking with a lender, bank, mortgage broker, all of those, and try to simplify them and add a little entertainment to it. So without further ado, let's get into the first one. And that is APR. Now this is built into the name, annual percentage rate. It is a financial measuring tool that somebody made up to express how much you'll be paying the cost of the loan overall. So initially, it's usually confused with interest rate, which is just an isolated fee associated with the loan. APR is to express all the fees associated with the loan, if that makes sense. If you're getting lost, I know, it's complicated, but let me break it into numbers. Say you have a $200,000 house, you've been approved for a 6% interest rate, and so you are paying $12,000 annually in interest. Now for an APR, closing costs are costing you an additional $5,000 and you had your closing costs rolled into your loan, which is awesome. But now you owe $205,000 with that additional closing costs, you know? So then the interest rate's charged that same 6%, and then that equals your new monthly amount, which is $12,300. So it went up $300. But the easiest way to get APR is to take that new amount, divide it by your original loan amount, $200,000, and then you come out with 6.15, and it's always going to be higher than the interest rate because, like I said, interest rate is one fee and the annual percentage rate is multiple fees rolled into one, expressed as a percentage. Let me know if that made sense because it is one of the hardest things to explain. Appraisal. Now, this is an estimate done by a licensed appraiser, ordered by the bank. Now, whether you buy the house or not, you still have to pay for it, but it is to assess the value of the property and compare it to previously sold houses to make sure that how much you're trying to pay for the house, it's actually worth that. Because if the appraisal comes in lower, say you're buying a $200,000 house and it only comes in 180, somebody's got to make up that 20% because the bank will not take it on. But if it comes in higher and you're paying $200,000 and the house is really worth $220,000, then you get instant equity. So it's really key to understand how an appraisal works. Then we have everybody's favorite unexpected fee, and that would be closing costs. Now this is outside of your loan. These are all the expenses, like I said, associated with bringing the loan together. It's making sure that everybody that helped put it together, your escrow, title, real estate agent, lender, all get paid. And that is an additional amount on top of your loan, generally rolled into your loan and just gets added to your monthly payments. That's why the loan or the lender will give you an estimation of closing costs up front to help you better understand. But a rule of thumb is to have 3 to 5% of the purchase price set aside for this on top of the loan. So just make sure you're saving as soon as possible. DTI, that would be debt to income ratio. You guessed it, it's the debt compared to your income. But side note, the debt that you carry that they point out are your car debt, your student loans, things like that compared to your monthly income to make sure that out of all the income you make, your debt gets taken out and there's enough left over for your house payment and not have you stretched too thin or struggling. It's really just to make sure that you can actually afford your house. You may have heard of discount points or points before, and this is just 1% of your loan charged to you by your lender to lower your interest rate. The great thing about this is with a lower interest rate, then your monthly payments get lower and you might be able to afford a higher loan amount than you thought before by paying a lump sum up front. So say you have $200,000, they charge you $2,000 and then you lock in that lower interest rate. It really is just a creative way for a lender to figure out and calculate the numbers so they are to your benefit and you can get into a house. Interest. Now we all know nothing is for free, especially when you're borrowing other people's money. This is the fee associated with taking out somebody else's money, a little amount added on extra every month, but it definitely adds up. Now the cool thing that's happening right now is that interest rates are at an all-time low. So say a couple years ago you applied and got a 5% interest rate and you wanted to buy a $500,000 house. Now that they've dropped to 4%, you apply again, you can now buy a $550,000 house because you get 10% more in buying power. It all calculates down to your monthly payment, but this is definitely something that you should be talking to your lender or your local real estate agent about, or even me, in figuring out how maybe you can even upgrade the house that you're in and buy a bigger house all of a sudden, or buy more than you originally thought you could. So look into these things. Interest rates are wild. LTV is the next one, and no, it's not a TV brand. It is loan to value. Simply put, it's the amount that you're borrowing your loan compared to how much the asset is worth, the value of the house. Now, this is exactly why loan officers, the banks are ordering appraisers to go visit the property to make sure that it's worth as much as it is, so that they feel sound in letting you borrow the money. And this is how they assess the risk, really, on whether or not they're going to push your loan application through. We got a couple comparables. I'm talking about lender versus mortgage banker versus mortgage broker. They're kind of all interchangeable, but I wanted to go over the differences because they're definitely there. Now, first off, we have a lender. This is kind of a universal term. Whoever you're going through to borrow the money, they're lending you the money. Now, whether this is a financial institution like a bank or it is a private company that you are taking on, that is up to you. Whoever you want to borrow your money from, that choice is left up to you. But it's good to know the differences and positives and negatives of who you're visiting, because the next is mortgage banker, and this is like a sector of the bank. Banks specialize in multiple things: savings accounts, investment portfolios, things like that, and it's just a portion that they have a specialist associated with. And then you go to a mortgage broker, and all they do is loan houses or loan money on houses. That's their specialty. That's what the company specializes in. So it's up to you if you want to roll your loan into, your bank because you trust them and they've done such a great job, or you go to a specialist, a one-off company that you've heard good things about or get recommendations from. But like always, I will always tell you to get 3 estimations. So I wanted to touch base on net income, but you really can't talk about the topic without talking about gross income, because usually they're swapped a lot. But gross income is all the money you make up front, and then the taxes get taken out, and then you're left with your net income. That being said, with your net income, a lot of people are like, I make $100,000. This is how much I can afford every month for my house payment. Give me the loan. But really, when it comes down to it, after taxes get taken out, maybe you have $75,000 left and they don't want you overextending yourself. Maybe you have some other debts too. So they have that all in their calculations, and leave it up to them to tell you exactly what you can actually afford, because we want you to be more on the realistic side than off in la la land. And then lastly on the list, incredibly valuable for real estate agents, but clients alike, is knowing the difference between a pre-qualification and a pre-approval. Because a pre-qualification is like you're out at lunch with one of your lender friends and you throw some numbers around. This is how much I make, this is how much I pay in taxes, this is my credit score, this is how much my debt is, how much you think you can give me? And they throw you a number. But the pre-approval is actually when they start getting all the paperwork, that intense submitting your tax refunds, pulling on your credit, just getting everything where they prove that they'd be able to give you the money, and then it gets sent into underwriting to make sure that all this stuff is true. So there's a couple different levels, but just knowing that you should have a pre-approval letter and speak with the lender before you even start looking at houses is really the message that I want to send out to first-time home buyers. Well, to be completely honest, I totally lost track in how many words I threw your way, but hopefully some of them stuck and it makes it easier to communicate and speak a little financial lingo with your mortgage broker, lender, banker, whoever you're talking about money. But if you have particular questions, reach out to them about your loan and not me. I'm a real estate agent by trade, not in the financial or lending industry whatsoever, but the industries are so intertwined. I just was trying to shed light a little bit so you can better understand what's going on in the process. Now, that being said, thank you so much for watching, and I hope you're having a spectacular day.